This is Larry Domenici, a student in ED 750. My topic is the price-earnings ratio. So what is the price-earnings ratio and why is it important? Imagine you find yourself short of cash. Not an unusual development for many of us. You have a car you'd like to purchase, a room you'd like to renovate, or perhaps a vacation you've planned and haven't been able to take. You find yourself coming up short on cash. Well, you get lucky. You have an extremely innovative employer. You've worked for this employer for 15 years. You expect to work for another 10 years. The industry is stable. You're a steady performer, and your employer brings forward a novel offer. The opportunity is to accept from your employer a one-time lump sum payment in exchange for the earnings that you otherwise might receive over the next 10 years. An interesting offer. And the offer proves to be a significant number. Your employer offers $900,000 to you as a one-time payment in exchange for what, in lieu of your earnings over the next 10 years. Well, we want to analyze this offer. So we would take and use as a numerator the price that's being paid to you, the $900,000, and divide that by the denominator of $75,000, your salary. Working through that calculation, the result is 12. This is a price-earnings ratio. In exchange for your earnings of $75,000, you're being paid a price of $900,000 or a multiple of 12 times. While this is an unusual arrangement for an employee and employer, this is how Wall Street analyzes and values stocks. As a matter of fact, not just Wall Street, but European markets, Asia market, global markets use the price-earnings ratio to value stocks. As it turns out, companies are generally in need of cash. It's not unusual at all for very high-quality companies to find themselves in need of cash. They generally have two approaches: to either borrow money and go into debt and take on those responsibilities and obligations, or to issue shares, which is giving up a piece of ownership of the company. They do that in exchange for selling you shares at a share price. Connected with the shares are your right to the earnings of the company. So we might take a share price and divide that by earnings per share in order to calculate a price-earnings ratio. The ratio helps analysts and investors understand how expensive or relatively inexpensive shares of a company might be trading for. For example, let's take the case of Johnson & Johnson, a very stable company. Perhaps Johnson & Johnson has been in existence for 125 years. I know they've been around 100 years at least, so they're quite stable. Johnson & Johnson has a share price currently of $140. That's as of the 24th of May. They have earnings per share of $5.40. So the $140 divided by the 5.40 in earnings yields a price-earnings ratio of 26. On the other hand, Berkshire Hathaway, Warren Buffett's company, has a class of shares available to common shareholders called Class B. Those shares sell for $203. Earnings per share for Berkshire Hathaway are $10.89. Inserting the $203 share price as a numerator and dividing by the denominator of $10.89 yields a price earnings ratio of 18.5. So even though Berkshire Hathaway is selling shares at $203 and Johnson & Johnson is selling shares at $140, in terms of the amount of earnings that are generated, Berkshire Hathaway shares are actually less expensive than Johnson & Johnson shares, which are selling for $140. In order for us to relate a little closer to this concept of the price-earnings ratio, let's do a little investigation by going to yahoo.com. Once we go to yahoo.com, you'll see a ribbon of choices across the top of your screen, finance being one of them. Click on finance, and you'll see at the top of the page of Yahoo Finance is a box that would allow you to put in the name of a company or the stock symbol of a company. Insert the name Macy's, and you will be given a stock profile. The stock profile will show you that Macy's currently trades for a price-earnings ratio of approximately 6 times. Let's do the same for Walmart. You could input the name Walmart, or you could input the symbol WMT, which is called a ticker symbol, into the stock selection box. We'll get a profile on Walmart and be able to readily identify that the price-earnings ratio for Walmart is 35, 7 times more expensive than Macy's. Why is that the case? Walmart's been performing much more reliably of late than has been Macy's. Walmart is being successful in developing their internet retail segment of the business, as well as maintaining profitability in their bricks and mortar operation. So the price-earnings ratio for Walmart at 35 times is significantly higher than is for Macy's. This suggests to us that investors feel that Walmart's going to be successful in growing their earnings in the future, more successful than Macy's. Finally, as a third company of comparison, let's input the name Amazon. As we look at the information on Amazon, we'll find that Amazon has a stock share price of $1,823. Earnings per share for Amazon are $24. By doing the math required by the price-earnings ratio, we find out that the PE, or price-earnings ratio, for Amazon is 76 times, more than twice that of Walmart. This suggests that Amazon, in the view of investors and analysts, has greater prospects for profitability and earnings growth than does Walmart. And we saw that Walmart is viewed by investors as analysts as having brighter prospects than does Macy's. To repeat the ratios, we have a price-earnings ratio of 6 times for Macy's, 35 times for Walmart, and 76 times for Amazon. I hope that this has been of some interest to you. The price-earnings ratio is used on a daily basis in all of our capital markets, and it is a starting point in security analysis. Thanks very much and have a nice day.